Hello and good morning. Very warm welcome to you all. Today's webinar is Climate Change and Financial Risk from the British Chamber of Commerce. My name is Russell Toop. I'm from Cheshire Consultancy, helping leading cutting-edge financial technology companies established in Asia. I'm a member of the Financial FinTech Committee with the British Chamber of Commerce, and this webinar is part of a series, A Road to Net Zero. The panel will be recorded and there'll be a number of questions can be added through the webinar. To start off today, I'm going to introduce the panelists, starting with Michael Savatico, Head of Asia Pacific ESG Business Development at Trucost, an S&P Global firm. He's based in Sydney and has had many years' experience working with investors and companies consulting on industry trends. Next, we have Boon Chong, who is the Director of Group Sustainability at Singtel. Boon Chong started his career at Singtel in 1994 in corporate communications and also has significant experience within ESG and sustainability. And lastly, I'd like to introduce Stefan Ulrich, Managing Director of The Warren. Stefan set up The Warren earlier this year after many years of expert consultancy experience within sustainability. I would now like to go over to Stefan for him to give us a short presentation on the latest developments within the industry. After these, we will move through to Michael and Boon Chong and follow through with questions at the end. Over to you, Stefan.
Thank you very much, Russ. Give me just 1 second as I bring up the screen here. Hold on, this should be the one. Can I check, can my slides be seen? You should all be seeing the title slide now. Yes, Michael's nodding his head. Fantastic. Welcome, everybody. Thank you very much for joining us today. So I'll try to keep this brief because we have some excellent presentations coming from Michael and Boon Chong. So my role is just to give you a little bit of an introduction to the TCFD and to the background why there is such a thing as the TCFD. So maybe to start us off with a bit of dark humor from the sustainability crowd. Now, this is in no way meant to belittle the current crisis, but to drive home why it's more important than ever to act now on climate change. You may or may not have seen that. There's actually been a temperature anomaly in Siberia this year. And just last week, temperatures in Siberia hit 38 degrees Celsius. Now, just to let that sink in for a second, that's 10 degrees hotter north of the Arctic Circle than it was here in Singapore. So this is what that looks like on one of those climate scientist charts. And what you see here in the background, this pink band, if you will, that's climate scientist simulations for the worst case scenario that is currently accepted. Now, what you see there, the black line, if you look at that, you will see that this actually is way outside. It's literally off the charts. It's way outside even the darkest predictions. And it is a taste of what things would look like currently based on the worst scenario that we have out there by 2100. So here's the thing. We don't have to wait for 2050 or 2100. Climate change is already happening all around us, right? And one thing before we get started on the TCFD proper, one thing to bear in mind when it comes to the deliberation of whether or not you should start looking at this from a risk perspective for your company. There is actually reason to believe that the models that you see out there and the things that science tell us, they may actually be wrong, but not wrong in the sense that they're overemphasizing the risk, but rather that they're underestimating it. Because it's kind of built into the system that scientists would rather go for the consensus and rather err on the side of caution when it comes to putting out statements than to be seen as somebody who's alarmist and extremist. So that gets us back to the idea of like why companies should care about things like climate change. Take that 38-degree example just now. Imagine for a second that Singapore experienced an anomaly like that. Think that, say, temperatures might go from 38 to 48 sometime in the next 5 years, 10 years. What would that do to your business? Would your supply chain still be intact? Would your workers be able to come to work and do their jobs? And like, there's a whole lot of issues that would come from something as simple as the temperature going off the charts for a little while. Now, what is the TCFD? What does TCFD stand for? The TCFD was the Taskforce on Climate-related Financial Disclosures. It was convened in 2015 by the Financial Stability Board, and itself, the Financial Stability Board came out of the credit crunch and the great financial crisis. And its mission was to develop consistent, comparable, and efficient climate-related financial risk disclosures for all companies. So we're talking anybody with public equity, anybody with debt, any company and any financial institution should consider adopting the TCFD, implementing the TCFD recommendation. The goal is to give investors and other stakeholders the tools they need to make useful decisions as we go about decarbonizing the economy, to avoid the worst case, the worst outcomes, and to increase, of course, the resilience of reporting companies. Doing that, you can only, you cannot manage what you cannot measure, right? That's an old adage. And the TCFD recommendations are meant to be the tool that you can use to measure the risk, and then from there to go on and manage it. Now, what the TCFD identified as they looked at how to come up with a system is there's two main categories of risk here: physical and transition. Physical is what happens to your business as the climate changes. Transition is what would happen to your business as the system changes, as we go about decarbonizing, as, say, a carbon tax might go from $5 to $100 to $130 US as they have in Sweden. What does that do to your business? So that's a risk, and the TCFD helps you address both of those. It's worth mentioning that this is not just the thing that happens in Europe. So the PRI is a global organization, the Principles for Responsible Investment. They're making TCFD reporting mandatory for all their members this year. Of course, the EU is behind it, but more interestingly for us here in Singapore, MAS published 3 consultation papers just last week on June 25 that are heavily based on the TCFD recommendations. Now, the recommendations were issued in 2017 and have seen quite a bit of support, growing support since then. And apart from so it started out in 2017 with 4 true pioneers, of which we're quite lucky to have one of them here with us today on the panel. And it's very encouraging to see that in just 3 years, the number of supporters in Singapore has actually grown to 20. By now, it's already another 2, so it's 22 by now. So strong support for the TCFD recommendations, and now is as good a time as ever to get on board with this. What are the recommendations? So they're based on around 4 core elements: governance, strategy, risk management, and metrics and targets. And they are split into altogether exactly 11 recommendations, as mentioned before, both for financial and non-financial companies. This is an overview of the actual recommendations, and today, for because of time constraints, we won't have the chance to go through all of them, but you're going to hear a bit more about them from Michael and Boon Chong in just a minute. One thing to note, maybe any of you who are involved in your companies or your clients' sustainability reporting will see that there's quite a bit of things here that give you a sense of deja vu. Like you've seen that before, say, board oversight of climate-related risks and opportunities, very similar to what GRI has to say on these topics. For today, the main thing to emphasize here is probably this one. This is scenario-based analysis, and maybe just 1 minute on that. What that means is essentially the exercise consists of picking a couple of the established climate change scenarios that are out there by the IEA, by the IPCC, and looking at the real world implications of those climate scenarios and applying them to your business, ideally to your whole value chain. But that is a rather elaborate exercise that will take some time to build. You've got to secure buy-in from your stakeholders, internal and external, and you got to develop the internal infrastructure for all that. Like, how do you handle climate-related data and all of that? So ideally, you'll be starting, and again, you'll be hearing about that from Singtel in just a moment. You'll be starting with a part of your business and then gradually grow that. This is probably also another, just for purely pragmatic reasons, a good slide to show. Looks a little bit confusing at first. What you see here are some of the main reporting frameworks that have something to say on climate. The top three are mainstream, if you will, like generalist reporting frameworks, of which GRI is the most popular here in Singapore, currently at way over 90% of all companies that report use GRI. And as you can see, GRI is actually, out of the three generalist ones, is the best aligned with the TCFD recommendations. So most of the points that the TCFD recommendations raise are covered by GRI. So if you're doing a GRI compliant report, you're already halfway there. The big thing here to note is, yes, the GRI doesn't have anything to say on scenario analysis, but that's fine because the TCFD give you plenty of tools and plenty of material that you can use. And of course, there's other help out there in the market if you need it. So you're well covered. If you're reporting according to GRI, you got an excellent segue into implementing the TCFD recommendations. So just to close, the TCFD recommendations will affect just about all types of Asian companies, especially if you're seeking funds from European institutional investors. This thing is coming, and you will be at a severe disadvantage if somebody 2 years down the line knocks on your door and says like, okay, well, show us your TCFD metrics, and you don't have anything. That's going to be a very, very major issue and might get in the way of you being able to continue to get at least cheap access to funding. There is a bit of a learning curve involved as these new reporting requirements are phased in. So again, you want to start now, not when everybody's already like heavily involved in it. But the good news is, if you're already doing sustainability reporting, then you have a clear path to integrating it. And it's not quite such a heavy lift, at least initially. I believe the slides will be distributed later on. So here is a couple of useful links to get you started. And later on, if you ever want to talk to any of the panelists, like I believe Sabina will be quite happy to share our details with you. One last thing before I hand over to Michael, if you happen to have your mobile out there, just please do snap the QR code and have a think if you can consider becoming a TCFD supporter today. It doesn't actually come with any obligation straight out of the box, but it's a great way to get the conversation going within your company. Thanks so much. That's all I have for now. Michael, over to you.
Stefan. Just a very quick question there, Stefan. I mean, that was a great coverage there, but you know, for Singapore specifically, you know, the sea levels is an area where I believe the government is investing heavily. Is that something you've come across or heard about so far?
Oh yes, look, I would definitely include that in the scenario analysis. At least if you're, I don't know, you might be out in Jurong, where you might have real estate close to the sea level. These things would definitely be within the ambit of a scenario-based risk analysis. There are, again, coming back to the science, there was a lovely piece out just last week where a glacier in Antarctica doesn't seem to be connected to us, but seems to be melting at a much faster rate than anybody predicted. So it's lost about 3 kilometers. It's retreated 3 kilometers inland in Antarctica. And if that thing were to completely disintegrate, then sea level might not rise by a meter, but by 1.5 meters, and it might not be 2,100, and might be a lot earlier. So is that sure? No, absolutely not. But that's what risk analysis is all about, right? Assigning probabilities to certain eventualities, and then to see what would that do to my business. So yes, by all means, I would definitely include sea level rise as one of the primary concerns for any company in Singapore. Because ultimately it's a relatively low-lying, lots of the interesting areas are quite low-lying here.
That's true. And I live on the East Coast, so it's certainly a concern.
There you go.
So, but just going back to the TCFD requirements there, is there a legal requirement for these, or are these just frameworks to be followed? Or is the reporting a legal requirement?
Moving from one to the next, at the moment, the TCFD recommendations were designed to be voluntary, but what's happening now is that the regulators around the world are picking them up and are integrating them into actual mandatory requirements. So in the EU, that's already happening. There's a non-financial disclosure directive that is impacting lots and lots of companies out there. Out here, we're still at the implementation stage, but MAS, as I mentioned, has like 3 consultation papers out just last week. Bank Negara mentioned it, and there is a thing called the Network for Greening the Financial System, which has a lot of the regulators and the central banks are getting together to coordinate their actions. And you can see that this is gaining a lot of regulatory momentum. So in that sense, again, like you want to prepare now so that when these things move from voluntary to mandatory, that you're prepared, that you have everything ready. And I believe Boon Chong and Michael will be in a great position to help you, to show you how it's done.
Okay. One more question we have coming from one of the guests today. They're just curious, with regards to your GRI slide, it seems to be out of alignment with TCFD. Is that?
Should I share my screen again? I can.
Yeah, maybe.
I understand. I understand why that might have been a bit confusing. Okay, so let me go back. Everybody should be seeing the barcode or the QR code.
Yeah.
Okay. So, okay, what you see here is the greener it is, the more aligned the framework is. Now, CDP and CDSB are not generalist reporting frameworks. So they are carbon reporting frameworks. And yes, they are more aligned than the generalist ones. But out of the three, so up here, I think I need to split this into two, I guess. So GRI, integrated reporting, and SASB are the three mainstream reporting frameworks. And out of those, GRI has the most green, if you will. So anything governance strategy, risk management, metrics and targets are reasonably aligned or at least moderate aligned. And then the one exception for GRI is strategy. Whereas here for integrated reporting, you have some gaps in strategy, metrics and targets. It's almost not covered at all, very limited. I should add, this comes out of that's in the links actually, this comes out of an initiative called the Corporate Reporting Dialogue. They ran a project that had all the frameworks in there, like all the representatives of GRI and SASB and all of that, and they were all in there to analyze how much the TCFD recommendations are aligned, and this is the end result. So this is a summary of that.
Okay, great. Thank you, Stefan, for that. I think at this point we're going to move over to Boon Chong at Singtel. And he's got a fantastic story covering how Singtel has worked with sustainability and the developments. I noticed in particular, actually, the scoring, you're AA rated for your ESG stewardship. So well done on that.
Thank you. Absolute pleasure to be here to share our experience with you guys. Sorry. Next, please. Okay, so I think for companies, trying to set out on this TCFD journey, you need to understand why you are doing this and also the strategy and the policies that you need to set around it. So just to quickly share what we do. This is our sustainability framework on the left. So it is pretty much aligned to the ESG framework, just that for S, we split up into people and community. And I'll focus on the strategy diagram on the right, which is our environment strategy. So that is to create the smallest footprint. And we have two pillars. One is on product stewardship, because electronic waste is actually the key waste stream for our industry. And of course, the most important will probably be climate change and carbon. So it is really about reducing our carbon footprint and also to cater to all the climate risk factors. Companies will probably have all those EHS or HSE, health, safety, environment policy. So years ago, we used to have HSE policy, but because environment became so important that we actually took it out to be a standalone policy. So we have an environment policy. And 4 years ago, we actually recruited our very first environment specialist in the sustainability team. So not many companies, property developers industry actually have a dedicated environment person looking at this strategy. Next, please. Okay, so to start off, the journey, I think there are a few things that you need to do. So like I mentioned, you need to have the strategy, the governance, which Stefan talked about. So the first thing is really to understand your own business operations carbon footprint. So CDP, which used to be known as Carbon Disclosure Project, will be a good start. So that will help you to understand your carbon footprint generated from the value chain and the business as well. So back in 2015, climate change and energy management was, surfaced as a material topic, but not as important. But it became more important when we did in 2017, we redid our materiality review, and it became even more important. I think more people are becoming to become more aware of climate risk, and especially with aspect of hot weather. The other thing is we did a life cycle assessment. So life cycle assessment, basically, we did an environment impact and social impact in our supply chain. So understanding where our impact is. So from a telco industry perspective, almost 90% and above of our carbon footprint came from our networks. So our network will refer to our mobile network, all the telephone exchanges, things that will support all the mobile and internet access for consumers like yourself. And also for suppliers, because without them, our business can't be operational. So what is our share of their carbon footprint? So that will be known as a scope 3. So we set a science-based target back in 2017, and that is to reduce our scope 1 and scope 2 carbon footprint by 42% by 2030, which is 10 years away from now. And the baseline is 2015. And just earlier this year, GSMA, you may be familiar with it. So that is the Global Association of all the mobile operators in the world. We are also supporting their goal, which is to achieve net zero emissions by 2050. So that is a very, very aggressive target, I would say. Okay, let's move to the next slide. So this is how we look at climate change. It is how our business is affecting the climate, and also how is our business is being affected by climate. So on the left, you will see, obviously, based on our business operations, we are producing carbon footprint, like I mentioned, 90%, comes from our network. So how do we make it more efficient, especially data center? Like today, everyone is working from home. Cloud computing is very, very important. Businesses are doing a lot of cloud computing because they don't have to invest, and all the data centers are with us. But they're outsourcing their carbon footprint to us because data center is a very big electricity consumer. So we will have to look at, how do we reduce it? So of course, the basic stuff will be all the LED lights, making sure that the energy is efficient. But how about using renewable energy? I think that is one big piece of work that we need to do. And our impact, the impact of climate change on our business, this is what is already alluded to. For example, the flood risk in Singapore. 2 years ago, because of the low-lying area, one of our telephone exchanges in our the eastern area actually got flooded. So that was really, reality struck true. So we installed, anti-flooding devices, and even not just in Singapore, but even in our Australia operations. So things like, car park basement, our backup generators are all moved up from the basement to the first floor and above. Simply because of flooding risk. Next slide. The next few slides will be the TCFD framework, which Stefan has already covered. So I will not go through it, but really, it is about setting strategy and governance management, around how do we govern, and how does the company govern environment and climate risk. Next. And the metrics and targets, of course, like SBTI, that really requires companies to set targets and to talk about your performance over the next few years. How do you achieve those targets? Next, I'll spend more time on the last slide that I have. Okay, so this is how we did our TCFD. Most companies will probably just, go out to appoint a consultant, but this is not what we do. We actually decided that we will do our own investigation first. Once we get all the necessary information, then we will go out to get a consultant to help us with it. In fact, we just called for an RFQ, an RFP for, for consultancy work on this piece. So you mentioned fiscal risk, transitional risk, but we also talk about liability risk, because I think from a telco perspective, liability risk is actually something very, very real. So things like contractual and legal obligations. What if, we are not able to provide our services due to BCP, due to climate risk, especially in Australia, where we operate through Optus, our wholly owned subsidiary. We're talking about floods, cyclones, we're talking about bushfires. So in the event that we're not able to provide services, what does that mean for us, from a legal liability aspect? Let me just maybe zoom in on, say, the income impact. So of course, obviously revenue, market share, but the third one, insurance premiums. I think that is interesting, because from an insurance company's point of view, these will be pretty big risk to them. So how do they charge premiums, to companies that are of high risk? So we will have to plan that, into our TCFD plan. Even things like disaster recovery. So in Australia, we are a co-founder of this Australian Business Roundtable, and basically it is a consortium of companies, banks, insurance companies coming together to assess and to see how the industry or the entire nation can come together to work around climate risk. Obviously, one of the research findings that they came out with was that the cost of prevention is actually much lower than the cost of disaster recovery. So if you plan your network well, your business well, it will be much more cost efficient compared to trying to do network recovery and service recovery. Okay, and renewable energy projects, I think this is really a very, very big thing. SBTi targets, when we're talking about, say, 42%, or even net zero, they are very, very aggressive targets. So if you just go by run-the-mill type, very business as usual type of energy efficient programs, you're not going to make a big difference. There's no quantum leap. So renewable energy projects, I think it is getting a lot of attention of late, because companies are now looking at it, how renewable energy can help to lower their carbon footprint, because it is very, very green. So you may have read that, in March this year, one of our data centers in Bedok, which is in the east, we actually have the entire roof with solar panels. So that is actually, able to power up like 400 over HDB flats. In fact, it is our biggest solar energy projects in Singapore today, but we are looking at, how do we have more, not just in Singapore, but in Australia as well. All right, I'll end my presentation here. Thanks.
Thank you, Boon Chan. That was very, very detailed and very interesting. We've got a couple of questions here. So the first one, just using CDP as a reporting mechanism, is that something you think should be used more or less, or what's your feeling on that?
It has to be more. In fact, I saw a question by Massimo, right? So it is not easy. It is not easy. In fact, in Singapore, there are only 2 companies in the A leadership scores, because it is very, very detailed. So companies will be stumped already if they don't even have a strategy, because CDP requires a company to disclose their strategy, the whole governance, the whole policy, and all their programs, numbers, very, very detailed. And I think that puts companies off, because it is just not easy. But I think it is really a baby step. You have to start somewhere. So the journey, the experience that I shared, it's not overnight. We started like maybe 2013, starting finding our footing, and it took us like 7 years to get to where we are today.
Wow. And just I noticed you mentioned SBTi as a target, and obviously there's a degree of science behind that target and how it's calculated. Are you able to provide a little bit more background to that and how it came about?
Yeah. All right. Okay. So like I said, consultants are actually very, very helpful, with such projects. So science-based targets, number one, you need to know your carbon footprint, and then doing all the scenario analysis the 2 degrees, 1.5. In fact, now, because of the IPCC, Science-Based Targets Initiative requires companies to start scenario planning using 1.5 degrees Celsius.
Okay, got you. And in terms of, you've obviously gone through some very real world scenarios relatively recently, specifically with the flooding. Was that, do you think with hindsight, that was something you could have anticipated, or did you have enough policies and disaster sort of recovery solutions there to deal with it when it happened?
Yeah. I think definitely from a business continuity planning point of view, the company is pretty good at that. I think the flooding, because of I think flooding is not common in Singapore. So I think that kind of took the operations people by surprise, because it was really knee-deep. Those who stayed in Singapore may remember that the water level actually reached the bus stop seats, and people were standing on top of the seat, while waiting for their buses. So that was how bad the flood was. Really, from a BCP point of view, all the climate risks that we talk about, even the suppliers, so all these will have to be taken into total consideration.
Okay. And good luck with your net zero goal. That's a very aggressive time frame.
Thank you.
Are you confident? Are you confident with it?
With renewable energy, yes, we are.
Good, excellent. And the solar panels on the HDBs, that's certainly, I think, something that we're looking to see more of those.
Certainly.
Okay. Thanks, Boon Chong. And I think finally we're going to move over to Michael Savasco at True Cost down in Sydney. Sorry to leave you to the end there, Michael. I'll pass over to you and look forward to hearing really about the solutions that people can put in place and how you can measure these climate change risks.
Yeah, thank you, Russell. Thank you very much. And look, the two great presentations before me as well from Stefan and Boon Chong. I spent the last 9 years working with investors and corporates in the ESG space. 9 years, I'm not sure if that sounds like a long time in people's career or not, but if you think about it from a climate change perspective or an ESG perspective, 9 years ago, most of the people didn't even know what the acronym ESG stood for. And climate change was so far off their radar that they weren't considering it. We were measuring it back in 2013 here at True Cost as part of S&P, and really starting to understand things like the governance and strategy around climate change. And that's a long time before TCFD became relevant, official, really 2017. And it's just been an astronomical take-up of TCFD. And there's plenty of reasons why. It's not just because the scientists are telling us. We're seeing the regulators pick this up, the exchanges pick this up, the principles of responsible investing pick this up as mandatory in their reporting for their members. The momentum behind the assessment of climate change from both corporate and an investor perspective is well, here's my prediction, is only going to increase over time. And one of the main reasons, for that, if we move to the next slide, please, Sabina, is the concept brought to us by the World Bank, and in 2017 was when I started to pick up on this around the concept of building back better, and it's more relevant today than ever before. And the concept of building back better is based on, well, what do you do after natural disasters? And the quicker you build back and the better you build back, the lower it costs. Well, if we go back to Boon Chong's comment about mitigation being more cost effective than adaptation, adaptation is a very expensive way to deal with hazards. And these hazards are increasingly being produced or are a consequence of climate-related events. And that's what you can see here on the left part of the slide, where it talks about asset losses. And you see where it says 1, 2, 3, talking about the hazards. And that hazard could be, tornadoes, it could be wildfires, it could be extreme cold, extreme heat, floods, sea level rises. and the exposure that in this case, countries, communities, or if we extend that to businesses have to these events, the vulnerability that these assets have to these hazards, that differs depending on their location and the type of asset that they are. And then in terms of the socio-economic reliance, that's the impact on our economy from these events and the loss of these assets. This is the area that I've been working in for a large part of the last 9 years, is how do companies assess this? How do investors assess this? How do you aggregate this up to a portfolio level? How do you start to measure your exposure to Paris alignment or to an earnings at risk from transition? And these are some of the areas that we're going to, I was going to say dig into, but just let's just say give an overview of in the next 8 or so minutes. Before I move on from this slide, I just want to point out the chart on the right hand side. If you've had time to look at the title and the countries that are there, you'll notice that a large number of them are Asia-Pac countries, and maybe not all the ones that you'd expect. I mean, sure, China's up there right at the top in terms of the cost and the ability of reducing the cost based on building back better quickly. And people might point to that and say, yeah, sure, China, that makes sense. But if you have a look at the fourth country rather on that list, Japan, is impacted, and there is a cost to building back better more quickly as well. Or let's just face it, mitigating the costs is the ultimate way to reduce the expenses. All of these are captured in a TCFD analysis, and if we move to the next slide, please, Sabina. If you think about the consequences there and how TCFD is capturing all of this analysis, well, here's examples of organisations that we've worked with on TCFD reporting, and I think what I want you to take away from this slide really is that TCFD reporting it's more than just, okay, let's report something because the regulator's interested, or because they're the TCFD is backed by the Financial Services Board, and because Mark Carney was involved and he was part of the Bank of England. Really what TCFD is doing is saying, assess your current position. Where are you today? Benchmark what your exposure is today, because this is going to be the basis on which you assess and plan the future investments of your organization. And these investments can be long duration, especially if you're putting a factory down that you expect to get 30 years service out of. You need to take into account the next 30 years impact from climate change. And at the moment, the focus really is on how do we get to 50% carbon emission reduction in the next 9 years. So your investment is well and truly over one of the major hurdles that we need to achieve to keep our global temperature rises at a meaningful level for our existence. And I think there were some really good examples that Stefan brought up. If we could move to the next slide, please. So what does it mean to look at TCFD as we've seen strategy, governance, risk metrics, and data analytics. How does all that come back to a framework where you as an organization can say, well, where are the numbers? How do I measure this? How do I start to assess what my current exposure is? And at S&P within True Cost, we've been working on this for 20 years. And just to make the connection there between S&P, Standard & Poor's, and True Cost. True Cost is an organisation that existed for the last 20 years, bought by S&P 4 years ago, and is now fully integrated as part of the S&P solution. The S&P assessment of your exposure to TCFD, well, starts really with climate, but climate's part of the S&P Global ESG scores. And for anyone who still doesn't know what ESG stands for, environmental social governance, I'll give you the benefit of the doubt there, that if you're on this call, you probably do. But there's certainly, S&P's working a lot in that ESG assessment space now as well. And it just makes total sense. I mean, you know, part of our business is ratings, and we have that assessment, the history of assessing companies' credit ratings and default risk. And a lot of what we're going to see coming from climate change impact is increased default risk from decisions that are made that are affected by transition and physical risk. The impact side there that you can see in the pretty pink, magenta, if you like, is all about positive impacts, because there's a lot of positive that we can draw from TCFD analysis as well. And that comes in the transition side, where your business is positively affected by transition, and positively affected by transition meaning your investments are in environmental opportunities. Those opportunities might be from solar. I heard Boonchum mention some renewable investments that are going to help get to net zero. Well, if you're investing in renewables, or if you're producing renewables, you're actually part of the solution. And we do a lot of work with assessing your investments and investments as a corporate and as an investor, and their alignment with the EU taxonomy. So, you know, the idea being here, the EU spent a lot of time working on a taxonomy around responsible investment. It's been adopted by a lot of groups that have formed in the country level. I'm part of the Australian Sustainable Financial Initiative. We've just put our recommendations up to the steering committee. The steering committee includes a number of people who are very senior at banks and insurance across a number of investment areas, with oversight from the regulators as well. There's a similar initiative in Singapore, so this is being looked at that level as well. If we could move to the next slide, please, Sabina. It looks like you might need to click on this a few times. Yeah, I'm not going to do the transition. I'm just going to get you to click all the way through. There you go, and one more time. Lovely. So this is taking that framework of TCFD and saying, right, how does it look? How do we marry the data that I just showed you with the framework that both Stefan and Boone showed you? And this is an overview of where that data fits in and where it fits into your process. So if you're thinking back to, you know, what Stefan was saying about moving through, you know, what I'm going to call moving through a journey of TCFD, it really is about that baseline. Where are you today? Simple things like a carbon footprint. And when I say simple things like a carbon footprint, I say simple because I've been working with clients on them for over 5 years, but they might be new to you. If they are new to you and you're hesitant to understand what they are, you don't need to be, because these things are well and truly established within the assessments of companies. CDP certainly does a lot of work collecting that information. We use CDP data as one of the inputs into our data sets for carbon emissions. We go a step further and look at the attribution of the emissions. We're doing deep dives for our investors into their portfolios of companies that they invest in, or for a company, the portfolio of your operations. And scope 3 is something that wasn't talked about as much 2 years ago, but very much now we've got a head around how to measure scope 3 upstream and downstream. And we've been working with clients a lot on that, because that's a big part of the impact that companies have, especially if you're an energy utility or in the automobile sector. The clients we work with are very concerned about the product's footprint once it leaves the scope of the company that produced it. I think for people on this call, you would have heard a lot about stranded assets. It's been talked about for a lot ever since Bill McKibben labelled it back in 2011. I was certainly working on stranded assets in 2009. I just didn't know to call them that. You know, I mean, you really hit the nail on the head. Unburnable carbon and stranded assets. We do a lot of the measurement of that in our assessment, right through to all the different types of fossil fuels and the energy mix coming from those fossil fuels, including renewables. Transition risk is so if we look at the transition risk and physical risk, it is a scenario analysis. Interesting that it's the missing part of GRI. Thanks for showing that, Stefan. I didn't realise that myself, that there was that gap in GRI, because it is very much part of the area that I live and breathe in at the moment. You know, most of the clients that I've got are sort of happy with their understanding of carbon footprint and stranded assets. Where they're really concerned is the forward-looking assessments. What's the future risk that is within their investments as an investor, or their portfolios as a company, that they don't know about, right? But they need to be worried about, because we're moving very quickly to an environment where transition risk could happen rapidly. And we're seeing this as part of the UNPRI initiative around the inevitable policy response. We're certainly bringing that thinking into our carbon earnings at risk. So providing you with an assessment of the earnings at risk from a carbon price environment, the gap in the carbon price, where even if there is a carbon price in the country that you're operating today, what's the gap between that and what that carbon price needs to be to achieve our 2-degree aligned target, or 1.5 degree. Similarly, 2-degree alignment assessment is just that. EU taxonomy, I mentioned already. Physical risk, we dive deeply into understanding the physical risk assessment of companies. And really, when I say deeply, it means right down to the asset level. And you know, that means the type of asset, the location of asset, and mapping that back to scientific analysis of where the impact will be from a set of hazards. To give you an example of that set of hazards, if we can move to the next slide, please, Sabina. Here's a great way to visualize one of the hazards that we look at, heat wave risk. And it's just appropriate that it happens to be heat wave because of Stefan's reference to Siberia. You know, and certainly when you look at this chart, you might say, oh yeah, you know, look, there's a really dark red line across the middle, and it's probably right on top of Singapore. So maybe the people on this call need to be more concerned than others, but this is a 2050. So this is a snapshot. We've got these snapshots all the way from, you know, today through to 2050 and further, 2100. But this is 2050. And this is in a RCP 8.5. Now you might be wondering what RCP is. It's the carbon content, carbon concentration, or more than carbon concentration. It's a concentration of all the climate-related emissions that would lead to a warming on average of 8.5 watts per square metre. Might not sound like much, but I tell you what, if we get to that 8.5 watts per square metre, we're going to see global temperature, average temperature rises of almost 5 degrees. And remember that 5 degrees means significantly higher in some areas. I've got to add my Aussie story. I am based in Sydney. I don't know if that came across in the introduction, but I've got to add my Aussie story to Stefan's story about Siberia. And I don't know if everyone knows Will Stefan, but he's a well-renowned academic in the science space. He wrote an article on weather in Canberra, and to hit you with the one part that he brings out, he says, over the last 30 years, average number of days above 35 degrees in Canberra are 7 days, right? And he said, as scientists, we looked at, you know, there's different scenarios, and we said, right, what's the worst case scenario in our modeling for number of days above 35 degrees by 2030, so in nine years. And worst case scenario in their modeling was 15 days above 35 degrees in a year for Canberra. And then he says, in 2019, there were 33 days above 35 degrees in Canberra. I read that, I see what Stefan says, and I look at it and I think, you know, all the criticism we see about the science, and the science being, you know, exaggerated and alarmist, and I think we're getting enough points now. We're getting enough proof points that we can say that, if anything, you know, we should look at the science as a conservative estimate of a problem that we're all going to face. And so if you look at this chart, you know, again, this is based on conservative science estimates of where we will be, and in this scenario, where we'd be if we just operated as business as usual. And all the blue dots that you can see there could be your assets as a company, for instance, and we can run analysis on the heat wave exposure score, and start to do some analysis on the costing around that, as you saw from Boone's slides. I've got 2 more slides and 2 more minutes to talk, so I'm going to go through these quickly. But this one, I'm sure people on this call would understand. This is how investors are using the data. So this is much more from an investor perspective than a corporate. But the reason I've got this here is, if you're a corporate, you need to understand this, because this is how investors are comparing you to your peers. This is how they're including you in their due diligence and in their portfolio assessments. And it can be as simple as an exclusion. Exclude companies that are fossil fuel companies. Right now, the concept of exclusion to end up with a better portfolio might be connected with the question Russell being asked to Boone about the science-based targets, because the 2-degree alignment initiative came up with a little bit of a, we're dropping support for 2-degree alignment, we're dropping support for the science-based targets, and that sort of caused a bit of a ripple. But if you read into what they're dropping, they're not dropping science-based targets. Science-based targets still stand as a very substantial and well-founded assessment. What 2-degree initiative are dropping is investors using the science-based targets as an easy way to say, hey, my portfolio is carbon, low carbon, or hey, I'm doing the right thing. I got rid of fossil fuel companies. They're saying that is not actually changing the real economy. And what we need to do is change the real economy to be low carbon, not just divest from companies that are high carbon. So, and that sort of comes to the integration side of this, number 2, where we're actually bringing in the decisions. It's not just a flat exclusion, it's integrating it. That leads to, might lead to more investments in impact, which is a very specialized area of investing. But where I want to get to is the active ownership, where you're engaging companies. And I think that's where a lot of investors are heading. How do we work with companies to ensure they're aligned to a better outcome and change the real economic impacts of their operations? The last slide is really just to say how all of this fits into S&P Global. As I said, I am a true cost on my title, but I'm part of S&P Global, Standard & Poor's. We've been doing this S&P Dow Jones indexes for 20 years, sustainable indexes for 20 years. We're bringing this all through the credit ratings, working with all the companies on that, have ESG overlays. The specialized areas that we're working in, funnily enough, energy and commodities. I think it's been mentioned a number of times on this call. It is a massive area of climate impact, and certainly, it's a big advantage to have that expertise as part of the group. I'm going to stop there and hand back to you, Russell. Thank you very much.
Thank you, Michael. That was excellent. Very helpful to see how you really measure some of these targets and how you put things into practice, which I'm sure is going to help people who are watching this today. One very quick one before we jump in. We do have some good questions to cover, I think. So, but in terms of Australia and obviously the terrible fires down there, we did discuss this earlier, that they've sort of dropped off the radar a little bit with the effects of COVID-19. But what did you see from a company perspective and dealing with the fallout and the impact of that and insurance requirements and so on? I know that's maybe a bigger question, but could you give it?
Oh, look, I think the simple answer to that is there's been a strong reaction, and look, it's part of the fires, but the fires to me brought it home to the mums and dads. Look, I say that, as soon as I say that, I think that it actually brought it home to a lot of people in some in very severe ways, but I mean the mums and dads sitting in cities, not the mums and dads affected by the fires. It brought it home to the people that climate change is a real impact. Companies have been thinking about this, those companies who are involved, certainly the insurers. We've had floods, in Australia, up north in Queensland in the last couple of years. We've had the fires. The severity of these fires were bad enough to really bring it home to everyone. We've seen more reporting, more requests around reporting. So companies, want to understand their exposure to these physical risks. So I was going to say that, is it TCFD? I think what TCFD has done is just provide a great framework. That's what was missing. And, Stefan's introduction to what TCFD is the answer. The world was missing a consistent framework to assess these risks by. And so, companies were heading off in their own way. No one was sure if they were doing it the right way. Now they can say, okay, we can see the risks. We know people are concerned. We need to do something. How do we measure it? Let's use this framework and benchmark where we are today if we haven't already done something previously. And we do see a lot of the companies, the banks doing this. Banks are really concerned about this. A lot of the banks in Australia are highly exposed to residential mortgages. So, they're looking very closely at their exposures and in particular, all from an agricultural perspective, where the farms are, as well as companies who are looking to understand where their future investments should be and avoiding these areas, the fire risk areas, the flood risk areas, I was going to say the hurricane. We don't really have that issue in much of Australia, but certainly on the Queensland side, we do. So Australia's such a large place. We've got to affect all these hazards.
So I suppose coming back then to maybe investment firms who are looking to measure ESG performance, which one would you recommend, or would you look at equity returns and profitability, or the valuation multiples, cost of capital, when you're going through an analysis of a firm? Is there a specific thing that always comes to the fore in terms of how they view whether it's a good investment or not?
Well, so you've got the two sides. You mentioned investment there. So if we focus on how investors are assessing companies and to add to their portfolios, I think it's important to be looking at the climate change related impacts on that investment from a transition and physical risk front. And, nowadays you can bring into that, as I say, from a transition perspective, and earnings at risk. You can model that out to 2050, bring those costs back and look at what the impact is today. Or you could use our measure of carbon earnings at risk, which are assessing that gap between where the carbon price is today and where it's going to be in the future. Similar for physical risk, you can assess the potential exposure of the assets in the companies that you have. You can go right down to the asset level if you want, or you can sit at the company level, look at their assets that are there, and you can start to say, right, well, let's have a look at the balance sheet and what the impact is on these assets that make up the value of this company, and therefore bring that back into your modelling. Or you could very simply do it as a beta adjustment for an exposure. There's a number of different ways that investors have been doing it. One thing that I do note is that investors are becoming more sophisticated in the way they bring in ESG analysis. That idea of just changing a beta was a way that was first introduced into the concept of bringing in ESG. It's a very simple way to do it. I think nowadays investors are looking for a more sophisticated approach. They want a deeper dive analysis of companies. They want to know more about what the company's exposures are, and they want to bring that into a more detailed assessment of the company.
Okay. And just on, maybe keep it with you, Michael. Obviously, technology is an area where I'm very close to my heart. But what do you see in terms of technology advancements to help people, manage their ESG requirements and TCFD recommendations? Are you seeing this growing? Are you seeing investment within technology?
Technology in terms of solutions like renewables, or technology in terms of
whether it's scoring or obviously
scoring, on the scoring side. So definitely again, what I've seen is TCFD provided a framework also for us to take the work that we'd been doing for years and years and to put it into that framework. And so I think that's definitely an evolution of the way the data is being presented in tools, and whether that tool's a portfolio analysis tool. So for instance, you know, the work we did for GPIF, that's more standardized now in terms of how we can report for investors, where if you went back 2 years ago, the systems to create that analysis didn't exist. So certainly there's been a lot of evolution in the reporting around those. Again, sophistication, depth of analysis, I think that's it. Like, you know, it used to be okay, I mean, we're only talking really 5 years of this kind of technology, but it used to be okay just to take a cost curve and point where you are on the cost curve and say, this is the impact. Investors and corporates want more than that nowadays. They actually want to know right down to the level of, you know, what is our trajectory of emissions, and how does our future plans around emission reduction and commitments and policy and strategy affect that transition pathway. So you need to be working very closely with the company. So I think that's another evolution of the data.
Okay, fantastic. And maybe Boon Chong, you can maybe just give us an idea. What would you advise for a firm that's starting out on this process of analysing their risk and their ESG requirements? Is there a one-line sort of advice you might be able to give to those firms at that early stage?
Okay, I'm going to say be ambitious, but okay, baby steps, but maybe not too baby steps. Be confident, I think, really is around, you know, knowing what you want to achieve and how to achieve it, and persevere.
Okay. And, you know, as we're sort of hitting the top of the hour, but it would be wrong not to have at least one question on COVID-19. And I'm sure you've probably prepared quite a few over the last few weeks. But if there's one takeaway from COVID-19 and one thing to say about climate change risk going forward, do you think this is going to increase focus in the area? And what sort of solutions do you envisage?
Me?
I'll throw it out. Who wants to take that?
All right, since I'm on the mic. I think BCP is really a key thing for COVID-19, for climate change. You know, it is all around business continuity planning. So companies need to plan well and using technology to help them.
I'm just going to say the whole concept of build back better. You know, we've got a massive opportunity. We've seen countries who are governments who are creating initiatives to assist with building back better. This is an opportunity. You know, we know the problems. We're starting to companies becoming more confident in the science, in the reality. We're seeing the impacts. You know, and I think even though COVID-19 is a crisis, there's still money there to be spent. Governments are throwing money at investment, and you know, make that investment as a company. Make that investment with long-term climate impact in mind.
Okay, thanks, Michael. Stefan, anything?
Maybe just to close off, but I think COVID has shown us what disruption really looks like, right? And the one thing that I would put for everybody's consideration is there will be no vaccine for climate change, right? The UN, United Nations University, predicts that there might be 1 billion climate refugees by 2050. Now, bearing in mind that those people will not just all suddenly start packing their bags in 2050, and that it took like all of 7 million refugees from Syria to almost make the EU fall apart. This is something we need to deal with today. It's not realistic to expect that somehow we'll be able to carry on as usual as the rest of the world is falling apart. One thing maybe, Michael mentioned stranded assets and what the UNPRI calls the inevitable policy response. I saw a coal prospectus a few months ago here in Singapore, Coalplay, like issuing like a small bond, like $15 million. 300-page prospectus, not a single mention of climate or climate risk or anything. And even if you're on the fence about the science, one thing that's undeniable is that there's like 100 big financial institutions out there that will not give you money for coal anymore. So if that is not a material risk, that your fiduciary duty would tell you to put on that report, on that prospectus, then I think something's seriously amiss. And maybe to close on something more positive, I think it's amazing how Singtel takes this approach and implements it bit by bit, and then actually integrates the findings into business strategy. Because that's, I think, something that we should emphasize in closing, is that the TCFD recommendations are a tool that designed with a specific end in mind, that you can protect your business, that you can go out there and mitigate your impact as much as possible and adapt as much as possible. And I think that's, like, if you look at the pioneers where they are now, how they're doing that, I think it's great to see that it's proven to be working. So I would encourage everybody to just get on board with that and start now, because it will take a bit to get familiar with it.
Okay, so to summarize, obviously it's a fascinating topic, and it's certainly been an area where the Chamber has had a number of similar webinars with the other committee on sustainability. So I suppose our takeaways from the finance side really is the framework is there, the time frame is now. Thank you all for attending, Michael, Stefan, and Boon Chong. If anybody would like to get in touch with any of the panelists, we can pass that on. Please get in touch with Sabina. Thank you very much. And thank you, Britcham.